Okay, folks, Mike Veneto here, co-founder and chief investment officer here at Title Financial Group, where we help people launch and grow ETFs. Welcome to our happy hour show, Get Think Tanked. Here at the Think Tank, our research end, we like to bring great ideas, new people, concepts, all kinds of wonderful thought leadership to you. Today, we've got a very interesting show with Dr. Ellen Wald. And she's going to be talking a lot about energy, ESG, transition, and her new book, Saudi Inc., which the Arabian Kingdom's Pursuit of Profit and Power. There we got a copy there in her review. Beautiful. If you have any questions, put them in the chat. I'll make sure that either Cynthia and I get them to Ellen. And with that, let me introduce Cynthia Murphy, our head of research.
Hi, everybody. Cynthia Murphy, head of research for the ETF Think Tank. Thanks for joining us today for another happy hour conversation. There's never an ending amount of things to talk about when it comes to energy and energy transition and how do we get through this. So we're really excited to have Ellen here with us today. Ellen, go ahead and introduce yourself and tell us a little bit about your work.
Sure. Let's see. I have a PhD actually in history. I studied oil companies, actually, American and British oil companies that were working in the Middle East in the 1940s and 1950s to 1960. That was that's kind of my original training. And then I went on to work in the energy sphere more than the history sphere. So I run a consulting company called Transversal Consulting, where we provide all sorts of consulting projects. We do a lot of communications work, both for companies that are on the energy end. We also consult for other financial companies, for other consulting firms. We do a lot of, as I said, communications work, writing, speaking, and so on and so forth. I've been a frequent guest on Bloomberg News and NPR Marketplace and other NPR to talk about issues related to energy, but also especially the Middle East and Saudi Arabia and Aramco, which is really where I have most of my expertise. I wrote a book that was published in 2018. It's called Saudi Inc., and it's basically a history of Saudi Arabia and its energy industry. And it details how the oil company that we know as Aramco came to be. It really was it started out as an American company, a totally American company out in Saudi Arabia in the 1940s when there was absolutely nothing. And so I kind of traced both the history of Saudi Arabia and how it grew and the philosophy of the Saudi kings and the Al Saud family, and also how the company came to be a Saudi company and what their philosophy is in terms of their business, their view towards their energy resources, and how they kind of go about stewarding this incredible oil resource that they have. And so that's my book. I also recently co-founded an advocacy firm called Washington Ivy Advisors, where we represent the interests of legacy energy enterprises and also related institutions. And we've put out some really interesting projects so far. We did one about critical minerals, a video which is out now. And then we have a video coming up that we're going to release soon that has to do with pipelines.
Well, you're a busy person. I would guess something as big as the oil industry or energy as a whole, it takes a lot. It's interesting because, we mentioned a couple things at the beginning, and like the advocacy, the messaging, and that in our world, the ETF world, it bangs into that ESG term, right? And I've been a big proponent that the three worst letters ever put together for the ETF market were ESG. They just confuse it. And I think it's a crazy world for it. For example, we have 3 Sharia compliant funds that we subservice, and they're, out of all the funds we have, they're the only ones I've never seen have a redemption. And obviously their opinion of E and S are a little bit different than others out there. So I'm just curious, like when you talk about advocacy, is advocacy just saying, hey, we still need to exist, or is it, hey, we're a transition? Like what does advocacy mean? Because I found that most companies think of their ESG philosophy as more of a branding exercise than a real, we call it GSD internally, but I'm going
to let's just call it real impact.
Real impact. Yeah. Yes. So, yeah, go ahead and unpack some of that.
That's a great question, and I think the two are kind of intertwined, because I think that the whole philosophy and culture that's come along with this ESG movement has really pushed a lot of legacy energy companies, and many of them were doing this before anybody had ever heard the buzzword ESG. If you think about it, like when is the last time you ever saw a commercial for a big oil firm, say for Exxon or Chevron, that wasn't about algae or innovation or featured wind turbines or talked about their commitment to clean, green energy? I mean, when was the last time you saw a commercial for an oil company that actually talked about oil? You probably can't think of one, because that's not what they want to showcase anymore. And I do think that this ESG movement goes along with that. There is this incredible push for companies to present themselves as, for energy companies, especially legacy ones, to present themselves as not actually doing the thing that both makes them money and provides value and actually has to do with the products they produce. These companies might be doing great things for the environment and might be doing amazing things in energy innovation. In fact, I've been saying for a long time that it's just as likely that some of the major breakthroughs in clean technology and green energy and renewable energy would come from a legacy firm like Exxon or Chevron than they would come from, say, Tesla or a solar panel company. They all do energy, but Exxon and Chevron don't talk about their oil industry. They don't talk about the products that they provide that enable us to live our modern lives. And so, and a lot of them will admit this. They'll say, yeah, we used to do that. We don't do that anymore. And I think that there's been an incredible backlash against these companies as a result of that. People don't know that these companies produce the basis. They produce the hydrocarbons that are used to make refrigerants, that are used to make plastics, that are used for reliable transportation, for laundry detergent, for their contact lenses. They have no idea how much of their lives actually touch fossil fuels and hydrocarbons, because no one's reminding them of that. And so, my kind of position on this is that when you fail to remind people of this, they start to just think of you as the big bad oil company that's polluting, and you end up with frivolous climate lawsuits that they end up spending millions of dollars fighting, that are truly in their essence ridiculous. You can't blame Exxon for climate change in one locality. It's just as much Exxon's fault as it is Sinopec or Aramco or BP. But just because they happen to exist in your locality, they're getting sued. So, that's where kind of my position on the advocacy comes, is that we can't continue to live our modern lives. We can't have computers. We can't have this conversation without the hydrocarbons industry. And so when people say they want it to go away, they want to keep it in the ground, what they're really saying is we don't want to have this modern lifestyle anymore. And I think that gets lost in the conversation.
It's the people that don't want to know where chickens come from. They just want it on their plate at night for dinner, right?
They just want the chicken McNugget. They don't want to remember that it was a chicken at one point. Yeah,
exactly.
I think these people actually want it raw too, since it's not cooked.
But then when it comes, I think to answer like the ESG component, I also think that when it comes to ESG, there's a lot of misnomers about it. I actually a little while ago, I created a course for a company called Saga Wisdom that does classes actually mostly for people in the petroleum industry, for petroleum engineers. But they asked me to do this course about like, what is ESG? What does it mean for the energy industry and the oil industry in particular? And when I was creating that course, I learned a lot of really fascinating things about ESG that, people generally don't know. For example, there's basically no regulation when it comes to ESG disclosures and ESG ratings and ratings agencies. And so you can wind up with things all over the map. One of the most interesting things that I found was how a company like BMW can get a higher ESG rating from a particular agency than a company like Tesla can. And that has to do with kind of these weird quirks of the rating systems where they give you a better rating for, first of all, the more you disclose. So that's why big companies will tend to get higher ESG scores than small companies, simply because they're bigger, they can spend more time on their ESG disclosures, and so they put more information out there, so they get better scores. And then secondly, location, geography has a lot to do with it. European companies tend to get higher ESG scores simply because the EU has different disclosure regulations and more disclosure regulations than the US does. So that's how a company that makes diesel and gasoline-powered cars ends up with a higher ESG rating than a company that makes electric cars. Now, I'm the first person to say that electric cars are only as clean as the way that they're manufactured and the power that supplies them. But still, BMW is out there not even, they're making, diesel cars and gasoline cars, and they still wind up with a better score. So I think there's a lot there to unpack that people don't necessarily realize. And especially when you say like, oh, a company is ESG or this is an ESG fund. Well, what does that mean? What companies are they actually putting money into? And I think that people will find that the answers to that are very surprising and not what they would have thought.
But so who drives that unpacking of all of that? Because when it comes to like the main narrative is just green is better, everything else is terrible. And so we got to the punchline without getting to the process of getting there. So who is motivated enough to go unpack? Does it come down to advocacy groups? Does it come down to private enterprise having to get out there and educate? I mean, who's going to drive this conversation?
That's a really great question. And I think it interestingly enough, at least I found most of the information when I was looking for it actually came from the environmental groups because they were upset with companies that weren't green enough. So they were going out there and they were exposing, say, BlackRock. When you say here BlackRock, you think, oh yeah, Larry Fink, he's at the forefront of greening the financial movement. He's the one out there telling companies that they've got to get on this. They've got to publish their Scope 1 and Scope 2 emissions, and they've got to cut their emission. We want to see emissions reductions if we're going to, invest in them. So you think like turns out that you've got these other kind of more environmentalist groups or watchdog groups that are looking at BlackRock and saying, ooh, well, you say you're really green, but you know what? Those new rules that you told everyone are going to apply, they only apply to actively managed funds. They don't actually apply to your passive investments, and that's a huge component. And so actually a lot of your money is going to coal companies around the world. And so that's, I think, where a lot of the exposure comes in. I think that people who are looking at that aren't necessarily, they don't like the source. It's like, it's not my side, so I don't like this source, when in fact, the source is just exposing the information. There's also been some really interesting reports done by academics who are, academics in kind of business schools and so forth, who are analyzing some of the data and information that we now have about ESG funds and looking at, initially there was this, ESG funds are outperforming, everybody else. They're doing great. Well, now we have enough data to really look at this and say, okay, why were they outperforming? What was the source of this? And can it last? And there's a really interesting report. I'm blanking on someone's name, unfortunately. Someone in California who revealed that really the meteoric rise had a lot to do with the fact that just more and more inputs were going in. People were putting in more money. And to me, that said, hey, this is going to be like a bubble. And at some point, it's going to pop because you can't just keep putting more and more money in it. At some point, people are going to realize that that's why it's going up constantly, not necessarily because companies that have higher ESG scores are somehow creating more value or more resilient. That's the the kind of buzzword that I find that people use. Oh, ESG companies, they're more resilient because they're more resilient to climate change. That's honestly, I see that. That's baloney. That's a great marketing phrase, I would say, but it's not necessarily holding out. And so I think that's where some of the really interesting conversations I think are going to originate from.
So to me, the biggest issue with it is the E has some logic to it, but it doesn't mean, ignore all the companies that make hydrocarbons. It's helped them with the transitions and things like that. So the E is not terribly debatable. We all kind of agree we want a better environment. We just don't agree how to get there. The G, I think everybody agrees with, right? Everybody wants good governance, but it seems to be an afterthought in this acronym, right? It's also why Tesla does get bad scores, right? Because whatever you want to say about Elon, governance does not seem to be at the top of his list, right? Like it's it is what it is. And then the S is such a joke because everybody has a different S, right? So we have a social justice fund. They have their opinions on what should be done. And we have Sharia compliant funds. Believe me, they are not similar at all. They're completely different S's, right? And there's funds out there for the LGBTQ community, and then there's Catholic value funds. Those are very different S's. So the idea that they lumped all this together and made it this acronym, it's just so silly. I have a good friend.
Can I add? I just want to add, one of the most, I think, ironic components of that is that you can get a company that is, a company that does lithium mining or cobalt mining, okay, and they can get a high E score because, they're making the components for EV batteries, but they're engaging in, say, slave labor in Africa. And so, what about the S score? I mean, come on, guys. So it's very variable. There is absolutely no standardization. People can say whatever they want, but it's been a really great marketing tool, especially for I don't want to say younger people because we're really talking about basically I don't know. I mean, my father, he's 70, is really into this stuff. So I don't want to say just younger people.
It's definitely not the younger people. SoFi is a big client of ours, and we have multiple ETFs with them, and we're always like, you've got that cohort. Why don't you do ESG ETFs? That's not what people want to buy on our platform. Which I do think the ESG, if you throw away the ESG word, so Cynthia and I, we sit down at the beginning of the year, we say, what do we think the trends are? And one of our theories is a resurgence of what used to be called ESG investing, but more being called impact or something like that. And I think, within our case, the funds we have, they're not using some random data source. They're using people who are in those communities doing the work and has authenticity. And I think that's kind of similar to what I'm hearing from you. You're able to advocate for the fossil fuel industry because you know what's real and not just taking data. Because when you take E, S, and G, it's like taking 3 great ingredients and mixing them together and expecting it to be a delicious meal. Well, you can't take truffle oil and
chocolate.
Foie gras and chocolate, throw it all in and be like, here's 3 great things that are really important. A truffled chocolate covered foie gras, which I'm sure the foie gras does not fit the E or the S. Yeah. Where I wanted to go though was I have a good friend who's written a book. He's written multiple books. He's a professor, John Lekumnik, and he argues that the proof of ESG is that we will see less famines and less wars because if we push this agenda, it gets people to change. And he tries to show this pattern of there being less wars. And I'm like, John, your whole book is based on us having a time machine to prove this alpha. I do get the concept, but
it sounds very nice.
Yeah.
I would add to that the concept of, the difference between a stock and a company.
Yeah.
So if ESG is creating all this confusion and it's diverting investment to companies that may not necessarily be impacting sustainability, like such a big integrated oil company, for instance, are we actually skewing our ability to actually reach the ESG goal because we are helping finance the wrong businesses that are more, they're just better at marketing because they don't have the baggage of oil? So, I mean,
they wash.
Yeah, is there a consequence actually to the evolution of this energy reinvention?
Exactly. And so I think there's a couple things to unpack there. As a historian, it's basically I'd say that it'd be impossible to kind of prove his thesis correct or whether it would be correct. However, there definitely are things that you could look at as examples, because the idea of, we now call it ESG investing, but actually, it has really long roots. The predecessor was called socially responsible investing. And in fact, you can trace those roots all the way back to the Methodist Church in the 1800s, which urged its members not to invest in companies that were involved in vices like alcohol, tobacco, weapons, and gambling. And other faiths had similar principles. Quakers, Muslims, you guys said you have some Sharia-compliant funds. And Methodists and Quakers actually developed the first ethical unit trusts in the U.S. and U.K. by creating these vehicles to ensure that their investments were in companies that met their ethical standards. But they used negative screening. So they said, we're not going to invest. We're avoiding businesses that trade in alcohol or tobacco or gambling. Then you have kind of the opposite of that, which is, can we use the money to actually create change, as opposed to, we're not going to support things we don't like, to, can we support certain things in order to promote our values or promote the values that we want? And that's kind of, I would say, like the reverse of it. And there were definitely SRI funds that came about in the 1970s. The very first mutual fund was launched by two United Methodist ministers who wanted to avoid investing the church funds in companies that contributed to the Vietnam War effort. So they hoped, at least, that with their funds money, they would be able to impact decisions made by companies and push them to adhere to the worldviews that they found, desirable. And then, you move on, say, to anti-apartheid movements. That was a big issue. In fact, there was a comprehensive anti-apartheid act in 1986 that was passed by Congress that banned any new investment in apartheid South Africa. So that's a way of kind of trying to use investment to create change. I think that today ESG has gotten all muddled. People are muddled about whether they are using ESG funds or these different kind of social funds as a way to avoid investing in things that they don't like. So, if it's the Catholic values one, they're going to avoid investing in companies that make abortion, supplies or drugs or whatnot. Okay, so, but that money isn't going to cause these companies to say, oh dear, I better stop manufacturing, the birth control pill or the abortion drugs. That's not going to impact change. So how do you impact change? And I think that gets more to the issues of when banks and financial institutions decide that they're not going to lend money to finance projects that are deemed like socially, I don't want to say irresponsible, but bad. So you had this kind of movement where, banks didn't want to lend money to gun manufacturers or private prisons, for example, companies. And then you're starting to see that when, in the energy industry, and you're starting to see that come about where they're refusing to finance new energy projects. And that, I think, is starting to have these really, I don't want to say dire, but really world-changing effects. So it used to be say you wanted to build a big infrastructure project in a developing country like Egypt or Iraq or something. You could get, financing from the World Bank. Well, now that these ideas have kind of permeated, it's hard to say if you want to build a big pipeline somewhere, it's hard to get financing for that from certain, very reputable international institutions. And I think that when it comes to developing countries who see these kinds of projects as, they don't just see them as, oh, it would be nice. They see it as, we want to bring electricity to people who don't have it and raise their standard of living. They're not going to just go around installing like wind turbines that don't work most of the time. They want, a power plant that burns natural gas, or they want a pipeline that brings in natural gas so they can have consistent 24-hour reliable electricity for these people. And if they aren't able to get what we would call like a Western or reliable financial institution, guess who's going to finance those? Those projects are not going to not be financed. They're going to end up being financed by Chinese and Russian financial institutions. And so I think we're seeing this bifurcation of the world. We're seeing, and it's happened like with India. India is all in on Russian oil. I mean, 2 years ago, India did not buy a drop of Russian oil. Now they are the largest customer of Russian oil, and they're buying it, they're refining it. The West won't touch it. The US won't touch it. Most of Europe won't touch it. So India's like, we'll buy it, we'll refine it, and then they're happily selling it back to, European countries who want to buy gasoline and diesel. And so it's just this bizarre bifurcation where you're not like keeping the stuff in the ground. You're just you're kind of dividing the world into places. You're denying yourself influence, first of all, and these countries are going with potentially kind of shadier financial institutions, and that could backfire for them, or it could lead to the proliferation of Russian and Chinese influence, because where the money goes, so goes the military and the economy and all of that as well.
What I love about talking to a historian is, one, it's not, oh, those damn kids today changed the world. It's like it's been repackaged, the same stuff over and over. But I think we're about to find out the cost of our soapbox, and I think that's the problem with ESG, is this moral high ground that has made us unable to have a real conversation about what does the infrastructure look like today and how can it actually sustain a sustainable transition as opposed to just a marketing transition, right? From that perspective, I mean, what do you know? What do you see out there in terms of where we're at if we were to just pull the plug on the pipeline and just put everything on the electrical outlet? What does that look like? How close are we to actually being able to do that?
It looks like we would live lives that are cold, dark, and hungry, or in my case, very hot, because I live in South Florida. We're not ready. We can't do it. That kind of technology. First of all, the technology is the technology to use renewables, as in sun and wind, and yes, hydro is renewable, but it can only work in places where there are favorable dams and favorable moving sources of water. So I don't always count that, though it is a good, reliable source of energy for certain areas. But if you're going to say that, like, oh, we got to turn off the natural gas power, and we're going to turn off the coal, and we're going to turn off the oil, the power plants, we would not, life as we know it would cease to exist. I don't want to, I'm not being overly dramatic. I'm being very serious. Like, we cannot power our modern lives. And I think that when people are talking about this energy transition, they have to understand that we don't have the technology to do that. We're not even close. I know people love to talk about, there's a lot of innovation going on in the battery sphere, and that is great and fantastic, but we're not even close to being able to get off fossil fuels. Just to create these batteries, we need fossil fuels. I mean, you need a plant, you need a factory to create this stuff. Do you know what you need just to get lithium out of the ground? I mean, there's a new lithium mine that they finally approved in Nevada. So it's brand new. It doesn't exist yet. They want to mine lithium. In order to mine this lithium, which is mixed into clay, they want to use a process that uses sulfuric acid. Well, they've got to build a railroad to the mine just to ship in the sulfur in order to create the sulfuric acid, in order to mine in order to extract the lithium from the clay before you can even get close to a battery. That's what they're talking. So I think we are so far away from ever being able to actually transition that the conversation to me is almost pointless. It's like, why don't we talk about how we can better utilize different sources of energy in the best ways possible? There are, for a good example of this, take teeny tiny Block Island off of Rhode Island. This was an island that got all of its power from diesel generators. That's the worst. That's like almost as bad as burning, coal, because you're polluting an incredible amount. It's very expensive. It's unwieldy. They had to ship in the diesel. The island wasn't connected to the larger, Rhode Island grid. And so they became kind of this pilot program for offshore wind. And for them, I think it really does make sense to build wind turbines offshore and to convert from diesel power to wind power. They're an island. It's pretty windy. They're a very small island. They have very small electrical needs, and they especially have much lower needs, in off season, when it's not, a vacation hub. So, and they were able to put in wind turbines that weren't too large. Apparently, as we found, the larger the wind turbine, the more likely it is to break down. So if you install like a 2 gigawatt wind turbine, it's not really going to last you more than 10 years. But the smaller ones actually last, and this is for offshore wind, not onshore wind. And so this really worked well, and it reduced their electricity costs, even including the cost of building a line to connect them to the grid, so that when the wind stops blowing, they can get energy from the mainland. And also when there's a lot of wind and they have excess energy, they can send it into the grid. For them, it made sense because the alternative was very expensive and very polluting diesel. Does that mean it makes sense to build, wind farms off the shore of New Jersey? Not necessarily. So I think that the best way to really do this is to talk about what works and what works best in different situations. One of the things that we found is that where natural gas as a power source expands, renewables can complement that natural gas very well. So, and when you get rid of natural gas, you actually end up having lower renewable use as well. So the point, I don't think, is to replace fossil fuels with solar and wind. You can't. They just, it's not that reliable, and we can't store electricity that efficiently. But they can work in tandem with each other. And in certain places, we can use them to reduce really high polluting types of things. So that's what I would argue, unless you want to say, well, our modern lifestyle just has to change. Everyone has to understand that their consumption has to go way down, that there's no commercial, airline travel. Like, we could reduce our consumption and our energy use a lot if we gave up a lot of our modern lifestyles. I don't see anybody out there in kind of the mainstream who's able to get any traction for that. So that's kind of where we're at.
You're muted, Mike.
That's all right. What I said wasn't that good. So I'm not going to repeat it. I'm glad I was muted. So I want to talk a little bit about regulation. So we banged on ESG quite a bit. Actually, in our industry, in the ETF industry, the SEC actually just came out with really strict naming convention rules to kind of, if you're going to use ESG, you better be able to prove it and all that sort of stuff, which I think is good. There's some parts of the naming rules that are a pain for innovation, but, telling people what they actually own is a good thing. Probably the biggest regulation change that I would love to see for investors that care about energy transition, or an E or an S or a G or whatever it is we have this ridiculous proxy voting where, you're a shareholder, you theoretically have this vote, and yet it's almost impossible to use for any change. And there's some great companies like Say and Tumelo that are trying to find ways to work there, but that's our industry. I'm curious, nobody ever wants regulation, right? They always say that we don't want more, but there's got to be some good ideas out there that are needed to allow these shifts, to incentivize people. And, I don't care which side of the aisle it is, but what are you seeing that's good ideas being put before policymakers here and abroad?
Yeah, that's a really good point. And, people always say they don't like regulation, but what I found is that the big established companies like regulations that make it hard for the little guys to break in. So,
Those the gates. We like gates sometimes. When you're the big boy, you like the gate. Yeah.
Exactly. So, that's why you see when a lot of times, like when they're going to come out with like a ruling about methane emissions in the oil industry, you see like Exxon and the big companies supporting it. Yeah, we're all for this, when really they're probably already close to compliance, if not already in compliance. And it's going to be harder for the little guys to comply just because of the expense. They need to install, expensive, monitoring equipment or something like that, when Exxon can take it and the little ones, not so much. So, and everyone wants to have good methane monitoring. No one wants to have methane leaks all over. It's not just bad. I mean, it's dangerous, but sometimes the rules are crafted with a lot of the support of larger companies, with the aim that that's not going to be so onerous for them, but it will be for others. So I think there's always that to keep in mind. I do think that the SEC's naming convention regulation, which I did look into, I think that is probably helpful, though annoying. It kind of reminded me of, when you go to the supermarket and you pick up like a box of something and it says all natural, and you're like, oh, that's good for me, right? Turns out there's zero regulation. Anyone could put all natural on that. I could be selling you a jar of petroleum and I could put all natural. I mean, it came from the ground, right? On it. Now, organic has a specific meaning, and you're not allowed to write organic on your product unless you meet certain conditions. So, so I think that, having some sort of regulations in terms of how you present yourself and what terms you use can be valuable, because then at least everyone knows, okay, this means this. Organic means no use of these kinds of pesticides and whatnot, as opposed to all natural, which is just, meaningless. I think the real issue that's coming up, at least for large companies, is that the SEC recently released this new climate disclosure rules that, initially when the rule was first, released for comment, they wanted companies to disclose Scope 1, Scope 2, and Scope 3 emissions. And in the final version, they've nixed the Scope 3 emissions, which is good, because basically nobody measures Scope 3 emissions. Nobody knows. That's like in your value chain or how people use your product. And, it's to me, it's just people who do claim to report Scope 3 emissions are just taking an industry-wide number that, in my mind, is essentially meaningless. No one can measure that with any kind of accuracy. So, and then they're only saying that large filers have to report this. And they don't have to start until 2026, and it's going to be some kind of gradual phase in. Of course, it's already been challenged, and the Fifth Circuit has already put a stay on it, basically saying, we don't know if this is actually, one of the things that they're challenging it on is this really under the purview of the SEC? Is this going to improve company performance or shareholder value to require this?
Really just protection. That's their only real mandate.
Yeah. So I think that's going to be a really interesting case to follow and see how that plays out. Because it does seem to me that, you never know with the courts these days. You really never know, but it does seem like it's going to be hard to make the argument that, this really is, that disclosing this information, which, by the way, is really hard to measure. Like you see these numbers, but you don't know if they're real. I remember I was trying to find out about, I was looking for information on, I don't know, the emissions of some car or something, and you get like 6 different numbers. Nobody, has, a really accurate number. So I think that they're asking people to report with accuracy something that you cannot really report with accuracy. And so you get into this territory of, if say they want to go out after this company for some reason, why don't we see if they, misreported something in their, Scope 1 and Scope 2 emissions, and we can hit them for that. that's very capricious in my mind, and is not really protecting anybody here, except maybe the SEC itself.
Or whatever data company is going to verify.
There you go. Yeah, exactly. It's, well, who are you? Yeah, this is the boon for the companies that do this kind of stuff. But they've got to, they can just blame it all on them, or they're going to go after the companies for being with, financial data is something I think that, is a much more clear cut thing than, what are your emissions this year?
I think that people outside the financial industry want to believe that. Living here, the data we get, it's like on every, so we maintain a database of all ETFs. We get data from Morningstar, FactSet, Bloomberg, and they all say different things. So we have to reconcile it into a common nomenclature. It's one of Cynthia's roles, which you love that part, right, Cynthia?
Ooh, so much.
So much, right? It's amazing. I guess you're up, Cynthia. What do you got for?
No, I'm just sitting here listening to you, Ellen, thinking I was skeptical about ESG before. Now I'm like really struggling to have any faith in this whole thing. Is it gonna matter for whatever the next iteration is as we come out of this confusion? That the whole thing seems to have zero credibility left. I mean, you can totally see why we come from an exclusionary past as a simple screen to approach it. I like oil, I don't like oil. So it's very clean cut. Everything else just feels like a game at this point. I don't know where we go from here, to be honest.
I think a lot of it has to do with the feeling that people get. I read one of these things where they kind of asked, investors that, like, why do you, what appeals to you about ESG? And it's more about that they're giving them a feeling that it's okay to put their money in the market because, like, the market is bad, right? It's, all these companies and people, and there's something nefarious about investing in the stock market and other markets. But somehow, if you do it through ESG, they feel less bad about it. And that, to me, it's a marketing genius. That was great. Like, somebody came up with a way to make people feel better about giving them their money to invest. And they managed to tap into something that it's that, to me, is I find that incredible and amazing, and I'm kind of awed at the genius of it. And that that they got all these people to put, and I mean, and we're talking like there are for a while there was public funds, so like teachers' pensions, for example, or state employee pensions. I mean, these are massive funds. We're basically automatically funneling people's pension money into ESG. And then during the Trump administration, there was a proposed regulation that said that people have to actively elect into the ESG public. If you have, a public, you can't just do it. You can't just let the fund managers do it. The individuals have to be given a choice. And then that regulation was then overturned when Biden came in. It is basically a way of funneling huge amounts of money into these ESG funds. And one of the other issues is that they're picking from a much smaller pot of funds. And so they're funneling all of this money into funds that have, on average, many fewer companies in them than non-ESG funds. And so there's a lot more risk and a lot more, potential for volatility there. And I think, the guy who's been, teaching in a public school for 20 or 30 years, he doesn't necessarily realize those risks. They're not being disclosed to him. And so that, to me, is just, and he feels good about it, or he doesn't even know about it. And that, to me, is really problematic, I think. And there's a lot of financial literacy that's lacking in this country. And there are a lot, people's money is all over the place and they don't even really know, and they just kind of let it go because they don't want to get involved, or they don't want to think about it, or they don't want to, it's too complicated for them. So somebody else is handling it. And that, to me, is not a particularly good thing. I do wish we had better financial literacy education as a whole in this country before we're, investing people's money in, funds that, that make them feel good, but aren't necessarily in their best financial interests.
All right. So,
and you can even say, sorry, Mike, you can even say that that on the fund side, that's providing job security. I mean, if you look at how much press BlackRock got for laying off 600 ESG related employees because performance wasn't there, so people weren't buying it, just tells you just how legit the whole effort is. But I'll let Mike.
Meanwhile, BlackRock was a major investor in the ADNOC, that's the national oil company of the UAE. They did this like kind of IPO type thing for their pipeline system. BlackRock was a major investor in that. And they did the same for Aramco. So this is the company that's saying, oh, we're, all ESG. Yeah. And then they're going investing in the pipeline companies of these these countries. That's what they do. They produce hydrocarbons. If you think you're going to tell Saudi Arabia or the Saudi Aramco, or you think you're going to tell ADNOC to stop producing hydrocarbons, I mean, come on, you're kidding yourself. BlackRock is not investing in that stuff in order to have a say so they can vote in a shareholder meeting to stop. I mean, no, these are companies that exist in countries that are monarchies, really absolute monarchies. BlackRock is not going to be able to, do anything to decarbonize them or tell them to keep it in the ground. No, they're in it to make money because it's a profitable enterprise, because despite what they say, we still need hydrocarbons and we're still going to need them in the future. And once they've gotten all the American ones to shut down by, litigating them out of existence, we're going to be left with the national oil companies like Aramco, like ADNOC, like Rosneft, who are going to be supplying the world's hydrocarbons.
Wow. All right. So
on that happy note.
Yeah. After this call, I want you to reach out to our GC and I want to trademark emotional alpha. That's going to be the value prop of exclusionary ESG funds.
Do I get a little? Do I get a little bit?
If we make some money on it, you can have some.
All right.
That's what it's all about. No. I do still believe that there is a market for impact investing. And when I say that, I mean, it's got to be authentic. It shouldn't be $20 billion funds that are excluding 10 companies because they got that. It should be small niches of owning the companies that can change things or the companies that you want to change things. And I think the best thing the SEC could do to have investing actually have an impact is change the proxy rules. But I don't want to rehash that. I want to come to your book because I think we're going to wrap up after that. So pick it up again for our audience. But, what's the short version? Because, I went to see the Dune 2 the other day. Did they take over because they had the ability to destroy a thing, so they controlled the thing? What's the kind of cliff notes for our audience and why they should take a look at your book?
Sure. So I think the cliff notes are, first of all, you should take a look at the book because, at least I've been told, it's very well written and it's a good story. This is not an academic book. It is a history book, but it reads really well. It's not quite a novel, but it definitely reads more kind of in a fiction style. So you're not going to be bored reading it. And what it really does is it exposes. Here's the short version. Here's one of the reasons I wrote the book. Fareed Zakaria was on TV and he said, the Saudis, all they do is drill holes in the ground. And that could not be farther from the truth. And so basically I wrote this book to explain why Aramco is one of the best run companies out there and positioned for very long-term profit and to be profitable in the very long term. And to do that, I had to go back and to explore, where Saudi Arabia came from, who this family is, and what their priorities were for a very long time, and how they managed to keep it keep this continuity in prioritizing what I call profit and power. They wanted to make money. And a lot of people think, oh, the Saudis are out there for, ideology or politics, or they want to spread Islam. No, the Saudis have always wanted to make money. Everything else has been secondary. And so I basically wrote this book to show that and to show how the company Aramco evolved, and that the Saudis who run it are basically they see their vision is to maximize the long-term profit of Saudi Arabia. They believe that they are the stewards of this incredible gift that God gave Saudi Arabia, these incredible oil resources, and their job is to protect it and to make the most of it in the long term. And I think that's a really when you look at it from that perspective. And yes, things have changed. The book ends before Mohammed bin Salman comes on the scene. But things have definitely changed. And if you pick up the paperback version, there's a new epilogue that kind of gets into that and the IPO. But this is where the company came from. And if you really want to understand what's going on there and how this national oil company is so different from every other national oil company, you should read the book.
Awesome. Well, I want to thank our guest, Dr. Ellen Wald. The book is Saudi Inc. Lots of great insights. It's amazing to hear a completely different industry and how it bangs into, and tangentially, but also in a meaningful way, our industry. Cynthia, any parting thoughts?
No, lots to think about over dinner tonight. So thank you for that. It was amazing. Thanks for your time today, Ellen.
Thanks for having me. I really enjoyed the conversation, and I hope that everyone listening did too.
Wonderful. Have a great day.
You too.